Joining me now, I have Saul Miller. Saul is the portfolio manager of the award-winning Nedgroup Investments Balanced Fund. The Balanced Fund utilizes an agile approach to asset allocation and stock selection. Hi Saul, thanks so much for joining us today.
Thanks for having me.
Really excited for our chat and to hear about the fund and your views for the year going forward. So as I mentioned, this is an award-winning fund, so I think it's quite fair to brag about performance of it. Since inception, it's the best performing fund in its peer group. So can you talk us through the performance over the last 12 months and what contributed to this exceptional performance?
Sure. So we've had some major events over the last year in South Africa. I mean, first of all, we've had the formation of the GNU, which has been hugely positive for South Africa. We saw a bit of a strong rand. We saw bond rates coming in quite a bit. And a lot of the domestically exposed shares obviously did very well. So your financials and your retailers have done nicely since that election result. We've also had some nice earnings upgrades for some, in particular the retailers. So we saw that quite recently for some of them in November, December. That also helped a bit of a run in those shares. So we've been quite nicely positioned in those domestically exposed companies. We also had a little bit of bond duration as well, which would have done well for us. So that's particularly driven our performance over the last year. Some of those valuations have obviously run a little bit hard, so we've taken a little bit off the table, but we still remain reasonably optimistic as far as SA goes.
So it's been a pretty wild ride for investors over 2024, and you spoke to some of this. We had the year of elections with Trump being re-elected. We had our GNU. We had the start of the rate cutting cycle in many countries. We saw the VIX spiking to levels last seen in COVID after the Bank of Japan unexpectedly raised rates. I could go on to name a few, but should we expect a roller coaster year in 2025?
I think the world is changing quite a bit. It certainly geopolitically looks different to anything it's been like certainly in our lifetime. You've got countries retreating in. You've got particularly the US focusing a lot more internally. It's becoming a lot more transactional in the way it approaches geopolitics, much like China, and that has all sorts of implications for the world, and that I would say increases risk and uncertainty for us, given that we don't really have we're going back to World War II. We're in a different environment, so things could be quite different. It does heighten risks a bit. Obviously, we've got Donald Trump, the new president, coming back again. The difficulty with Trump is obviously trying to ascertain how much of his policies will be implemented. There's obviously a lot of talk and bluster, but ultimately he'll probably rein in a lot of what he has promised to do. So a lot of his policies would seem to be reasonably inflationary if we think of things like tariffs or huge having a huge cutback on immigration or deportations, more importantly. These things could be quite inflationary. But at the end of the day, I don't think he wants to harm the US economy. I mean, he's happy to harm, obviously, other economies, but certainly not his own. So he'll probably have to rein in what he ultimately does with tariffs and what he does with deportation so that we don't get a spike in inflation. I'd say markets have certainly reacted already to a lot of what he has said that he wants to do. So, we've seen inflation expectations creep up a little bit. We've seen bonds rise a bit. We've seen the dollar strengthen massively, and it's strengthened by about 9% since he was elected, which is a huge move for the dollar. And despite all of that, and despite these higher bond rates, the S&P still remains quite elevated. It's not clear that his policies will have a major impact on growth. I think at the margin they would probably be positive via the likes of a more favorable tax regime. Government spending will probably continue, but probably not a significant change to the growth outlook yet. Markets are still, they're still pretty elevated on reasonable valuations. So a lot has been discounted already at this stage.
So inflation's not coming off. Trump's policies are inflationary. US economy just rages on, doesn't show any signs of slowing. So how does this bode for US bonds, and how are you seeing them in terms of valuations against other opportunities out there?
Sure. So inflation is actually quite tricky. So I mean, as I said, his policies on the face of it appear to be quite inflationary, but I think he will ultimately be reined in by the practicalities of not being able to have inflation run rampant, simply because if inflation runs too hot, you're going to see rate increases, we're going to see bond yields rise. That is certainly going to harm the US economy. I don't think he wants that. So I would think he will tone back his what he ultimately does in terms of tariffs and deportations, as I mentioned earlier. So I don't think inflation runs rampant. There's always a tail risk that it does, especially with the economy running as hot as it is. But I think there's a good chance he does pull back on certain aspects of his policy, so that you don't get rampant inflation. I mean, another important point to mention is that bases in the US are quite high. And when I mean bases of government spend, we've got very high deficits in the US. They're over 6%. They double what they've historically been. You've got this continual trajectory of rising debt levels. Hasn't been a problem. We've still got a strong dollar. We still have bond rates that are reasonable, so markets aren't worried. But at some stage, that becomes a problem, and you're going to have to rein in that spending. I mean, at least back to some kind of average level of, say, closer to 3%. So that is a medium to long-term headwind. You've got consumers that are not saving very much. Consumption is at a fairly high level. It's certainly at a higher level than it was pre-COVID. So good consumer confidence and a lot of spending. You've got these high bases, high earnings levels. That is all going to have to come down, I would think, at some stage. So we've certainly been completely wrong in expecting a recession, which never happened. But we still think the risk of a slowdown is there. And when that happens, that would obviously bring bond rates down. So it's not sort of clear that bonds are trading in an area that's unreasonable. They don't look especially cheap or especially expensive. We have fairly low conviction around where bonds would go from here. So we're not taking much bond duration at all, particularly in the US. We'd rather be in the shorter part of the curve, and we'd rather have a bit of credit. As in, we just don't have a lot of comfort on either direction for US bonds. For US markets, which obviously get affected by US bonds, we also think that they are reasonably expensive. Now, you're going to need a recession to probably bring those markets down. Markets don't just come down because valuations are high. So it doesn't look like that's happening in the short term, but over a more long-term view, we do worry about those valuations. We think there is better value out there. There's good value in SA, as I mentioned earlier, given the changes that we're seeing politically here. And there is some good value in the rest of the world. If we look at Europe, Europe is obviously struggling at the moment, but there's some low bases in Europe. There's obviously very low consumer spend. They're in a manufacturing recession. We're having some major political upheavals in Europe. We could see some changes, for instance, in the German government. You could actually have some government stimulus coming from there. So you could actually get a bit of an improvement in Europe over the next year, even though things look a little bit tough at the moment. And valuations are quite reasonable. We're seeing reasonable valuations in a number of sectors, whether it's the banking side in Europe or defense, which is obviously a theme that benefits from these heightened geopolitical risks and countries being more focused internally. So, there's some things that should do well. Net, it's not great for economic growth, but certain industries could benefit. So those would be some of the areas where we would be seeing value and where we would be positioning. But certainly not in long duration US bonds. That feels a bit like a coin toss at the moment.
So let's chat about China for a bit. Last quarter, you spoke about the uneasy Chinese consumer. Mm-hmm. So is this still a factor that's at play? And I know you have some exposure in China in Tencent through your Naspers holding. So there must be some good opportunities out there.
Yes, that's right. So, I mean, as you mentioned, the Chinese consumer, there's an issue around consumer confidence in China. And I mean, some of it's obviously cyclical, some of it is structural. The economy has been under a bit of pressure. You've got unemployment rising. You've had falling house prices, a negative wealth effect. And housing is still quite expensive, actually. So it's another reason why, you might not want to go out and spend a lot. So you've got these cyclical factors that are weighing on the consumer, and then you've got more structural factors. And, I mentioned, I think in one of the slides, I mentioned cultural factors. What I really mean is that China is a very authoritarian country, and it's become more so over the last few years. That, I would think is not particularly conducive to a rise in consumer confidence. There are not examples of emerging markets that have transitions from being an emerging market to being a developed market under that type of regime. So the likelihood of consumer confidence picking up is not something I would have a lot of confidence in. And that's obviously important because they obviously have huge pools of savings, and if they spent that, you could see quite a boost. But it's difficult to see that happening. There's not a lot that's spent on welfare in China as well, and it's not clear that would necessarily change. That's obviously a lever of stimulus that the government could pull, but we're not seeing that yet. And even if they did pull that lever and did something more favorable on the welfare side, it's not clear that would galvanize consumers into spending. So you're kind of reliant on government stimulus, and they probably won't engage in any major bazooka type capital intensive spending. They probably want to keep on spending on developing their technology, which is obviously key to becoming, or key for them in terms of becoming less dependent on the West, and that doesn't necessarily give you a big GDP boost. Having said all of that, you still are getting some growth in China. They have been weaning themselves off dependency on the US. They've cut back on what they export quite a bit. So they obviously should have some defensiveness, or more defensiveness than they had against US tariffs and a particular and any kind of negative trade environment that we have under Trump. So you should have some level of economic growth in China still. And then you've got a lot of well-run companies. They're well capitalized. They are cash generative. So we think there still is some opportunity to invest in China. It wouldn't be at the level that we would have historically invested in, given current valuations. But there certainly is, a justification for having some exposure. I mean, as you mentioned, Tencent is obviously quite compelling. Valuations are reasonable. It's a very cash generative business. We're seeing a lot of share buybacks as well, which is positive. So a modest exposure, we think, is correct.
Okay, it'll be interesting to see how that plays out this year. So let's just bring it closer to home. South Africa is also facing some headwinds at the moment with the stronger US dollar and their tempering of their interest rate cutting cycle. But there are some positives around. So what are your views on SA equities, and where in the space are you seeing value at the moment?
Sure. So I mean, as you said, a stronger dollar isn't ideal for emerging markets, and we are one of the emerging markets. Generally, when you get a stronger dollar, emerging markets tend to underperform a bit, and that's what we actually saw in the last month. We've seen quite a few SA exposed sectors coming under quite a bit of pressure into this very strong dollar. Having said that, the dollar has obviously strengthened quite a lot. The rand has weakened quite a bit, so we would hope the dollar, although it probably stays strong, it hopefully does not strengthen dramatically from here, and we don't see any meaningful rand weakness from here. So the impact of that negative headwind, we've hopefully seen quite a bit of that already, which I think is at least positive when we look forward. Notwithstanding all of that, there's obviously the better structural environment that SA finds itself in. So we've got, when I talk about structural factors, I'm really talking about changes in the political landscape. The GNU is still working, which is fantastic. We've got some well-functioning government departments like Home Affairs, a new Minister of Police. These are things that certainly have a positive impact on SA over the medium term. When we talk about Home Affairs, we've obviously heard a lot about an improvement around visas. That's obviously fantastic, even in the short term, for tourism, which can pick up, which is good for our current account, and just generally good for our GDP. So we're seeing some of those changes. Eskom is obviously much better than it's been in terms of energy availability. And finally, we've had announcements from Transnet, which is obviously critical. So we are finally opening Transnet up to the private sector. There have been tariffs that have been announced, and they are reasonable. We know that our GDP came under huge pressure from an inability to move freight and coal and iron ore. We should see that improving over the next few years. Might take a bit of time to actually get the new locomotives in and fix the railways, but ultimately we will see a benefit. So that is hugely positive. We're seeing more spend coming through from SANRAL, which is also good. I mean, one of the big negatives is obviously water and municipalities, and that is where we still need to see some improvement. But things are certainly much better than where they were 6 months ago, and it almost places us, in a sense, in a better light than many other EMs that would actually be coming under a bit of pressure from tariffs and so on. That would obviously be less of an impact on us. So we're actually looking a little bit better when you compare us to the EM universe. So we think that bodes well for us. Like I said earlier, our valuations have improved, but they are still reasonable in some sectors, particularly in financials. We think they're still compelling. You've got decent dividend yields. You should have a reasonable growth. So you're looking at decent high teens returns from, say, the financial sector, which is where we would still have a reasonable exposure. And that's obviously a great return for an investor, and well ahead of inflation.
Sounds like there's a lot of opportunities out there locally and globally. So how have you put this all together in your portfolio positioning?
Sure. So what you'll notice is our bond exposures are reasonably low, and where we do have bond exposures, whether it's domestic or whether it's foreign, those are generally low duration, and there's more credit there. Given my comments about concerns over long-term interest rates, particularly the US being fairly uncertain, and SA yields have also compressed quite a bit as well, so we think most of that is done. So we'd prefer to stay away from duration domestically and globally. You'll see a reasonable exposure to our domestic financials and domestic industrials, which should hopefully benefit from a better GDP growth outlook for SA should we continue to see these changes coming through. There are some great opportunities on some of the offshore exposed companies that are listed on the JSE. So the likes of a Bidcorp is a fantastic business on a pretty decent PE. We've got a bit of Anheuser. Unfortunately, that's a business that really struggled over last year. That actually hurt our performance a bit, but it is especially cheap now, a sort of 12 to 13 PE for a global brewing company. We think that's certainly very cheap. So you've got those opportunities. And then, as I said, offshore, there are some themes that should benefit from this geopolitical tension. Defense would be one of those areas, and it's not trading on particularly demanding valuations. You've got financials in Europe that are also trading on fairly compelling valuations. So quite a reasonable spread of assets where we see fairly healthy returns, which are well in excess of inflation.
Thanks, Saul. Sounds like a great diversified portfolio, and hoping many good things to come in the year ahead. Thank you for your time today. We really appreciate it.
Thanks for having me.